You've probably heard all the chatter, right? Global economic shifts, local market movements. But what's really happening on the ground in an economy as dynamic as India's? Today, we're going to dig into an institutional financial report that, well, aims to cut through some of that noise.
Exactly. Our mission today is really to unpack the key insights, maybe some surprising facts, and definitely the crucial numbers from this comprehensive report by JM Financial. We're looking at their take on India's market strategy and the estimated earnings for Q1 FY26.
Okay, so where is investor confidence holding strong? Which sectors are actually driving the growth? And, where are some of those headwinds we keep hearing about?
We'll cover all that. We want to explore where things look solid and maybe where they're a bit shaky.
Think of this as your shortcut, really, to getting a feel for the pulse of the Indian economy right now. The source we're using is JM Financial Report and Strategy Expect Double-Digit PKT Growth in.pdf. It's a detailed analysis from JM Financial Institutional Securities Limited.
Right. So let's start with the big picture. India's market performance. It's actually been surprisingly resilient, despite what the report calls, global and domestic noise. The Nifty 50 index returned 7.5% just this calendar year up to the report date.
7.5%.
Okay.
And over longer term.
And 5% over the last 12 months. So, holding up.
That really does highlight continued investor confidence in the India growth story, doesn't it?
That's it.
Especially given everything going on globally.
It does. And what's really interesting is how the investor flows have shifted. The report points out that foreign institutional investors, FIIs, they were actually selling quite heavily from about October last year to February this year.
Selling, how much are we talking?
The number in the report is USD 25.6 billion in sales of Indian equities. So pretty significant.
Yeah, that's substantial, but you said flows have shifted.
Exactly, because over the last 4 months leading up to the report, it's flipped. Both FIIs and domestic institutional investors, DIIs, became net buyers. FIIs bought back around 5.6 billion US dollars.
Okay, so a reversal there. And the DIIs?
Even stronger. DIIs bought USD 24.0 billion. A huge inflow from domestic institutions.
Wow. So why this confidence? I mean, you've got geopolitical issues, uncertainty around oil prices, questions about Fed rate cuts. What's underpinning this?
Well, the report suggests investors are basically choosing to look past these near-term headwinds. They're focusing on India's fundamental growth narrative, plus what the report sees as its economic stability and, importantly, relative political and policy stability.
So it's that long-term view combined with stability.
Seems like it. A belief that the core story is strong enough to weather these storms.
Okay, that makes sense. Now let's get into the earnings forecast. That's really the meat of it, right? What are the overall expectations?
Right. So for the universe of companies JM Financial covers, they're forecasting a 12.8% year-over-year growth in profit after tax, or PTAE, for the first quarter of fiscal year 26.
12.8%. That's double-digit growth. Pretty healthy.
It is. But here's where it gets really interesting. If you exclude one major sector, banking, financial services, and insurance, or BFSI.
Okay. The big one.
Exactly. Without BFSI, that peak growth forecast for the JM Financial universe jumps to 18.2% year over year.
Whoa, 18.2%. That's a huge difference. So BFSI is really pulling down the average.
Significantly. And you see a similar pattern with the Nifty 50 index forecast. The overall Nifty patty is expected to grow 10.4% year over year.
Still double digits, but lower than the JM universe.
Right. And again, if you exclude BFSI from the Nifty, that growth number rises to 14% year over year.
Okay, so we have to ask, what's happening in BFSI? Why the weaker performance there?
The report points to a few things. First, loan growth seems to be moderating. It's slowing down a bit. Second, and this is crucial, net interest margins, or NIMs, are compressing, about 30 basis points year over year.
Meaning banks are earning less on the spread between deposits and loans.
Precisely. Then you add in relatively weak fee income growth and elevated credit costs. Banks are having to set aside more for potential bad loans.
Especially for certain banks.
Yeah. The report mentions this is particularly noticeable for mid-sized banks, so it's a combination of factors really putting pressure on that sector's earnings.
Got it. That really highlights how one major sector can skew the overall picture.
Yeah.
Okay, let's pivot then. Let's talk about the sectors that are driving that growth, the strong performers.
Absolutely. And there are some really impressive numbers here. Telecom stands out massively. The PA there is expected to rise, get this, 198% year over year.
Wow, nearly 200%. What's behind that?
It's mainly driven by strong growth in mobile broadband subscribers, people using more data, and improvements in ARPU, average revenue per user. Basically, providers are earning more per customer.
Okay, huge digital push there.
Yeah.
What about physical infrastructure?
Also looking very strong. Infrastructure PA for the Nifty component is projected up 130% year over year. And within the broader JM Financial universe, they expect 95% year over year growth for the sector.
And it's coming from...
Strong opening order books. Companies started the period with a lot of work lined up, particularly diversified names like L&T, KEC, KPIL, Alawalia, companies like that.
Makes sense. Lots of building going on. And that leads us to cement, right?
Exactly. Cement is also showing strong growth. Nifty Paint expected up 61% year over year. The JM Universe forecast is around 40% growth. This is helped by about a 3% improvement in prices quarter over quarter and decent demand, especially with some sharp price hikes down in South India.
Okay. What about consumer-facing sectors? Any bright spots?
Yes, consumer retail looks pretty good. Nifty Paint projected to increase 20% year over year. For the JM Universe, it's about 13.9% growth. A lot of this is driven by store expansion, just opening more outlets, plus double-digit growth in apparel, though that's partly off a low base from last year.
Right, the base effect. And pharmaceuticals.
Pharma is solid, too. Nifty Pete expected up 14% year over year, and the JM Universe sees closer to 30% growth. This is mainly coming from the domestic Indian business, but also some specific product launches doing well in the U.S. market for companies like Lupin, Dr. Reddy's, Zydus.
Interesting. A mix of domestic and export strength.
Yeah. And then there's oil and gas, a big sector weight-wise. About 10% of Nifty earnings, 18% in the JM Universe. Expected peak growth is 43% year over year for the JM Universe and 13% for the Nifty EPS. This includes good performance from Reliance's retail side and a positive outlook for upstream players like ONGC and Oil India.
So quite a diverse set of growth drivers when you look across telecom, infra, cement, some consumer areas, pharma, O&G.
It really is. And the JM report also flags a few other high-growth areas in their universe. Sugar up almost 50% year over year, media over 30%, EMS, electronic manufacturing services, up 27%, and healthcare around 22%.
Okay, so lots of pockets of strength. Now, we need to look at the other side of the coin. The sector's facing headwinds or maybe just more moderate performance.
Right, balance is key. And we already talked about BFSI. That remains the key area of, let's say, relative weakness. Covered banks expected to see an 8% PT decline year over year due to those factors we mentioned. Moderating loans, no more pressure, credit costs.
Okay. What about automobiles? I know that's a big one for many people.
Yeah, autos. It's a bit mixed. The manufacturers, the OEMs, under JM's coverage, are expected to see revenue grow of about 8.7% year over year, which isn't bad. But EBITDA margins are expected to contract by around 70 basis points year over year. So profitability is getting squeezed.
Why the squeeze?
It seems to be higher discounts being offered, maybe an unfavorable product mix shifting towards less profitable models, some tariff-related costs, and a modest uptick in commodity prices again.
Got it. Margin pressure. What about building materials besides cement?
That sector saw pretty subdued demand in the first quarter. Estimated revenue and EBITDA growth are low single digits, like 4% and 3% year over year, respectively. And PAT is actually expected to decline by about 3% year over year.
And the reasons there?
Influenced by the early monsoon hitting construction, some oversupply issues, particularly in tiles, and margin pressure from higher timber prices affecting wood panel makers.
Okay. How about consumer staples, everyday items? Any recovery there?
Not really seeing clear signs of a broad recovery yet. Demand trends look pretty similar to the last quarter of the previous year. Value growth is happening mostly because of price hikes made 6-9 months ago. But profitability. Margins are expected to compress compared to last year because companies are still working through higher cost raw material inventory.
So sticky costs impacting margins.
Oh.
And consumer durables, like ACs.
Yeah, a weak first quarter expected there, especially for air conditioning players like Blue Star and Voltas. The report estimates the whole AC industry contracted maybe 20-25% year over year, largely weather-related, delayed summer, early monsoon, bad timing for them.
Ouch. Okay, the internet sector, that's usually dynamic.
It's described as a mixed bag. You've got strength in food delivery and especially quick commerce. Swiggy's quick commerce gross order value is projected to grow maybe 20% just quarter on quarter.
That's fast growth.
It is. But other segments, like recruitment info edge as mentioned, are more muted. That seems tied to broader macro challenges and also heavy spending on branding. On the other hand, some players like Pay-to-Pmart are actually expected to turn Pay-T profitable, which is a big step.
Interesting mix indeed. What about hotels?
Expected to be a moderate quarter overall, the industry probably saw around 8% growth in RevPay revenue per available room. Though the report notes some individual companies might see a temporary dip, possibly linked to geopolitical concerns affecting travel.
Okay, and finally, textiles.
Facing some near-term issues, there is ongoing uncertainty around tariffs, which is expected to lead to a margin decline of maybe 2.5% in this first quarter. But there is some cautious optimism for things picking up in the second half of the fiscal year.
All right, so we've really covered a lot of ground here, digging into this JM financial report. It definitely paints a complex, but overall quite a robust picture of India's economy, showing resilience despite those global uncertainties.
Yeah, I think that's fair. We saw those strong double-digit PAT growth forecasts overall, especially if you look past the BFSI drag. And that growth is really fueled by some standout sectors: telecom, infrastructure, cement, definitely leading the charge.
While others, like BFSI, autos to some extent, and parts of the consumer space, are clearly navigating more challenging conditions.
Exactly. Different speeds for different sectors right now.
So this whole deep dive, it really underscores how India seems to be navigating these global headwinds by relying on its own internal stability and those diverse growth engines we talked about. Which brings me to a final thought, maybe something for you, our listeners, to ponder. As the global economy keeps shifting, how might India's diversified approach allow it to carve out an even stronger position globally in the years ahead? Based on what we've discussed today, what specific trends or sectors will you be watching most closely going forward?